Usually when we talk about a massive financial disaster, there is this really ingrained expectation of clear villains.
Right, yeah, like a movie plot.
Exactly, like a movie. You look at a market crash, you see that sea of red arrows just plunging downward on the trading floor, and the financial pundits just point at the screen and say, well, there it is. That's the greed. Those are the bad
It's
guys.
a very binary way of looking at the world. I mean, you're either greedy or you're not greedy.
Yeah, and it gives us a reason. It's clean, you know,
Oh, totally clean.
but then you step into the actual messy reality of human behavior and time horizons and the underlying plumbing of market psychology, and suddenly that neat little cinematic story just completely falls apart.
It really does.
We find ourselves looking at a financial landscape that is just incredibly murky.
It is the absolute definition of behavioral muddy waters. I mean, we like things to be categorized, to have a distinct moral failing we can point to, mostly so we can tell ourselves we would never be foolish enough to do such a thing.
Right, the whole I would never fall for that mindset.
Yeah.
Which brings us to the core mission of today's deep dive. We are tackling a question that has honestly haunted anyone who has ever looked at their dwindling bank account or watched the evening news in horror.
Yeah.
Why do incredibly smart, highly educated people make absolutely disastrous financial decisions? Like, why do we as a society keep falling into the exact same traps, decade after decade, bubble after bubble?
It is the perennial question of modern finance. And the source material we are unpacking today, it's a fascinating piece of analysis simply titled 15 You and Me.
Yeah, it's a great piece.
It really is.
Yeah.
And it proposes a profoundly different answer. It shifts the blame completely away from those easy, cartoonish targets and forces us to look at the mechanical ways information travels between different types of people.
Okay, to set the stakes right out of the gate, we really have to look at the sheer scale of the destruction we are talking about here. Because we aren't discussing, a few bad trades or a rough quarter.
No, not at all.
The analysis points out that the implosion of the dot-com bubble in the early 2000s literally erased $6.2 trillion in household wealth.
Yeah, trillion with a T.
Let that number sit with you for a second. 6.2 trillion evaporated. And then, not even a full decade later, the fallout from the housing bubble wiped away more than $8 trillion.
Those numbers are so astronomically large, they almost lose their meaning to the human brain.
It's just become abstract math.
Exactly.
Okay.
But it is vital to remember the physical reality of what those numbers represent. I mean, these are socially devastating events.
Yeah.
These aren't just abstract line charts dipping on a Bloomberg terminal. That 8 trillion means erased retirements.
Right.
It means millions of people losing the literal roofs over their heads. It means destroyed marriages, generational setbacks, and just a complete loss of baseline security.
And when you see destruction on that scale, like trillions of dollars vanishing into thin air, the natural immediate question is just why? How can we let this happen twice in 10 years? And the default answer you hear at every dinner party, and frankly on most cable news panels, is just human greed.
Always.
People are just inherently greedy, they flew too close to the sun, and they got burned.
But what if greed is just a lazy diagnosis?
Okay, I like where this is going.
The central thesis we are exploring today is that the root cause is entirely mechanical. What if the crashes aren't caused by a sudden surge in human avarice, but simply by normal people blindly taking cues from other players who are operating in a completely different game?
I hear that, I do, but I have to push back a little right away. Because it is really hard to look at a guy flipping 5 houses in Florida in 2005, lying on his mortgage applications, and not call him greedy.
Sure.
Like, are we saying the intent doesn't matter at all? The analysis acknowledges that greed is an indelible feature of human nature, right? Nobody's denying that people want to make a profit.
No one is denying the existence of greed. The issue is that stopping at greed as the ultimate explanation prevents us from learning the actual mechanics of the failure.
How so?
Well, think about a plane crash. If the NTSB investigator comes out and says, well, the pilot wanted to get to the destination too badly.
Right.
That tells us absolutely nothing about the hydraulic failure or the software glitch that actually brought the plane down. Blaming greed is like blaming gravity.
Oh, that's good.
Yeah, I mean, yes, gravity is why the plane hit the ground, but it doesn't explain the sequence of mechanical errors that led to the crash.
That makes a lot of sense. The desire for returns is the gravity of the market.
Exactly.
It's a constant. So what is the mechanical failure? Because the analysis brings up this foundational principle, and it's, quote, no one is crazy. And I found this incredibly difficult to swallow at first.
Like most people do.
Because when people make financial decisions that bankrupt them, it looks absolutely crazy from the outside.
It does. But the premise here is that people are operating with very scarce information and often without rigorous mathematical logic.
Hmm.
However, the decisions they make, even the ones that end in total ruin, made perfect rational sense to them at the exact moment they pulled the trigger.
Right.
They weren't twirling a villain mustache thinking, I am going to make an irrational choice today that will bankrupt my family.
Yeah, nobody wakes up and does them.
They legitimately thought they were making the smartest possible move with the data they had in front of them.
So if we just write off these massive bubbles as collective moral failings, we don't learn anything about how human beings actually rationalize their choices.
Precisely.
The analysis gives a really sharp comparison to explain why financial bubbles are so uniquely difficult to diagnose and learn from. It points out that a financial bubble is not like a disease.
Right. With a physical illness, like cancer, a biopsy gives you a clear, indisputable biological fact.
Yeah.
You look through the microscope, you see the mutated cell, and everyone in the medical community agrees on the diagnosis. There is no debate about whether the cell is cancerous.
But a financial bubble isn't a biological fact. The outcome is known in hindsight. I mean, the market crashed, the wealth evaporated, but the actual cause is endlessly debated.
Endlessly.
It's treated more like the rise and fall of a political party or an ideology. 10 different Wall Street analysts will give you 10 completely different reasons why the 2008 crash happened.
Oh, absolutely. Some blame deregulated derivatives, some blame greedy home buyers, some blame government policies pushing home ownership.
And the reason for that endless debate is deeply tied to how markets function.
Yes, you have to remember that at every single microsecond, someone has to own every single asset. There is no void.
Someone is always holding the bag.
Someone holds the tech stock.
Yeah.
Someone owns the deed to the overvalued house. Because the competition for returns is so fierce, the very idea that a bubble is happening will always be fiercely controversial while it is actually happening.
Right, because nobody wants to admit they are the sucker holding an artificially inflated asset.
Exactly. So the rationalization machine goes into overdrive.
Yeah.
When you are holding a stock that has doubled in a month and someone tells you it's a bubble, your brain immediately scrambles to find a reason why it's actually a fundamental paradigm shift in the economy.
You convince yourself that the old rules of valuation just no longer apply.
Right.
Okay, let's unpack this and try to ground this idea of greed versus mechanical error. Think about a massive, gridlocked traffic jam on the highway.
Okay.
If you are sitting there in park and someone asks, why is there a traffic jam? You could say, well, because people want to get home.
Right.
And technically, that is a true statement. The desire to get home, the greed for the destination, is an indelible feature of every single driver on that road.
Yeah. No one is out there just to sit in their car.
Exactly. But saying people want to get home does not explain the mechanics of the crash. It doesn't explain the phantom braking ripples, or the blind spot, or the fact that someone was following too closely while looking at their phone.
That is a perfect framework.
Blaming a financial bubble on greed feels exactly like blaming a traffic jam on people wanting to get home.
The desire to get home is the engine. It provides the forward momentum. But it's not the steering wheel, and it's certainly not the mechanical failure that caused the pileup. The accident happens due to a mechanical error in how we process the behavior of the cars around us.
Okay, so if it's not just blind greed causing the crash, what is the specific mechanical error in our thinking? Because if we look at the underlying logic of the analysis, it points to one profoundly dangerous, widely accepted idea in finance, and this really leads us to the core of the problem.
Yes, the core mechanical error. It is an idea that seems completely innocent, almost intuitive, but has caused incalculable damage.
Let's hear it.
It's the deeply ingrained notion that an asset has one single rational price.
The single rational price fallacy. We all just assume that a share of a company or a piece of real estate has a true fundamental value just floating out there in the ether, and the market is just trying to discover it.
Exactly. We assume that in a world where millions of investors have wildly different goals, totally different risk tolerances, and completely different time horizons, there is somehow one magical objective number that represents the correct price for everyone.
And when you say it out loud like that, it sounds absurd.
It is absurd.
To illustrate just how absurd it is, let's walk through the thought experiment provided in the analysis regarding Google's stock. It asks a very simple question. How much should you pay for a share of Google today? And the answer, the only honest, mechanically sound answer is, well, it depends entirely on who you are.
Let's break down the permutations of this because this really gets to the heart of the why. Suppose you are a young professional with a 30-year time horizon.
Okay.
You are buying this asset to hold until you retire. How do you determine the rational price?
Well, if I have a 30-year horizon, I need to know if this company is going to survive and generate cash for 3 decades. So the smart price involves a very sober, rigorous mathematical analysis of something called discounted cash flows.
Right.
Now, for the listener who isn't an accountant or a financial analyst, what is a discounted cash flow actually measuring in reality?
A discounted cash flow, or a DCF, is essentially a time-traveling math problem.
I love that phrase.
It operates on the principle that a dollar in your hand today is worth more than a dollar promised to you 10 years from now, simply because you can invest today's dollar and earn interest on it.
Right.
So if you are evaluating Google for the next 30 years, you have to project all the actual physical cash the company will generate over the next 3 decades, and then mathematically discount all that future money back to its value in today's dollars.
That sounds intense.
It requires analyzing deep, fundamental, long-term macroeconomic indicators. You are looking at global internet penetration rates, long-term regulatory risks, and the sustainability of their monopoly on search.
Okay, so I build my giant spreadsheet, I do the math, and I come up with a price based on 30 years of business fundamentals. But what if my horizon is only 10 years? Say I'm trying to park some money to eventually fund a child's college education.
In that scenario, the 30-year cash flow model becomes largely irrelevant to your specific game.
Totally irrelevant.
The analysis points out that for a 10-year horizon, the rational price is determined by analyzing the tech industry's potential over the next decade.
Okay.
Can Google's current management team execute their specific vision over the next 10 years? Are they going to win the current AI race?
Yeah.
That is a completely different set of metrics. You are no longer looking at 30-year global macroeconomic trends. You are looking at medium-term product pipelines and management competence.
And let's shorten the horizon even further. What if I am looking to sell within just 1 year? Maybe I'm a hedge fund manager trying to hit an annual benchmark.
Now you aren't looking at a decade of management vision at all.
Not at all.
You are looking at immediate, current product sales cycles. You are analyzing whether the broader economy is going to enter a cyclical bear market in the next 12 months.
Right.
You are looking at inflation prints and interest rate decisions by the Federal Reserve.
The 30-year cash flow model means absolutely nothing to you then.
Nothing. And frankly, the 10-year management vision means very little either. You just need to know if the stock will be higher next December.
Okay, and finally, what if I am a day trader?
Well, for a day trader, the rational price to pay is, quite literally, who cares?
Who cares?
Who cares?
Because the day trader is just trying to squeeze a few pennies or dollars out of whatever volatility happens between the opening bell and lunchtime.
Exactly.
And they can accomplish that goal at literally any price point. Whether Google is trading at $10 a share or $10,000 a share, if it moves up 1% today, the day trader wins their specific game.
And this raises the most critical realization of the entire deep dive.
Which is,
When investors have these fundamentally different goals and time horizons, the very concept of a ridiculous price becomes subjective.
wow.
Prices that look completely irrational to a 30-year investor can make perfect logical sense to a day trader. The data points they are using to justify the purchase do not overlap at all.
But wait, here's where it gets really interesting, and I want to pause here and challenge this dynamic.
Go for it.
If the day trader is literally saying, who cares about the underlying fundamental value of the company? If they don't care what Google actually builds or sells, are they even investing?
Well,
Or are they just playing a casino video game where the points happen to be US dollars? Because calling them both investors feels incredibly misleading.
it is a fair pushback, and the terminology is definitely part of the problem. You can argue semantics all day about whether day trading is investing or speculating or just gambling.
Right.
But the mechanical reality of the market does not care about our semantics. Their money is in the exact same market as your money.
They are swimming in the same pool.
Precisely. Let's look at how the plumbing of the stock market actually functions. It operates on an order book.
Okay.
Buyers list the prices they are willing to pay, and sellers list the prices they're willing to accept. When those two numbers match, a trade happens. The ticker price flashing on your screen, the number that tells you what your retirement account is worth, is simply the price of the very last trade that occurred. Period.
Wow. So if two day traders who completely ignore the 30-year cash flow model decide to swap shares back and forth at a wildly inflated price just to capture a microtrend,
That wildly inflated price becomes the official valuation of the company for everyone.
that is wild.
You might be playing a sober, rigorous game of chess, looking 30 moves ahead based on fundamentals.
Uh-huh.
The day trader might be playing a rapid-fire game of financial ping pong.
Right.
But you are both playing on the exact same board, and their ping pong balls are constantly knocking over your chess pieces.
That is a terrifying image because it means the fundamental value doesn't actually dictate the daily reality. And this realization that short-term players who do not care about long-term value can dictate the price for everyone, this is the exact spark that ignites a bubble.
Yes, and to understand how that isolated spark turns into a $6.2 trillion forest fire,
Yeah.
we have to look at what happens when the time horizons across the entire market start to shrink on a massive scale.
Let's do that because if shifting time horizons inherently destabilize prices, we should be able to see that play out in historical reality. And we don't even have to look that far back. The analysis takes us to the late 1990s, right into the heart of the dot-com bubble.
Yeah.
And the poster child for this era is Yahoo stock.
Absolutely.
Yeah.
In 1999, people look back at the chart of Yahoo and they say that was collective insanity.
Right.
The stock was trading at a massive, unjustifiable multiple of its actual revenue. The valuation made absolutely no sense. And if your time horizon was 30 years and you were running a discounted cash flow model, they were entirely right. It was financial madness to buy it.
But the core argument here is that it wasn't madness for everyone.
No, it wasn't.
The analysis points out that the environment in 1999 has shifted. We had the rise of early online brokerages, E-Trade, dial-up modems. For the first time, regular people could sit at home, watch a live ticker, and execute a trade in seconds.
Which was revolutionary.
It really was. And because of that technology, millions of people entered the market with time horizons that were incredibly short. For them, paying a zillion times revenue for Yahoo actually made sense.
Let's go back to our day trader from the Google example. A day trader in 1999 could get what they needed whether Yahoo was at $5 a share or $500 a share, as long as the momentum moved upward that day.
And the crucial context is it did move upward, day after day.
Exactly.
This introduces what the analysis calls the iron rule of finance. And it's a rule that explains so much of human behavior. Money chases returns to the greatest extent that it can.
Always. Money is fiercely agnostic. It just looks for the highest yield.
Right.
If an asset has momentum, meaning it has been moving consistently up for a period of time, it is actually a highly logical bet for a group of short-term traders to assume it will keep moving up for just a little bit longer.
Right. They don't assume Yahoo will go up forever. They just assume it will go up between 9:30 a.m. and 4 p.m.
Exactly. They just need it to go up until they jump off the ride. And because it keeps going up, more money floods in to chase that exact same daily return.
And this gives us the actual mechanical definition of how a bubble forms.
Yes.
A bubble is not just people getting greedy. A bubble forms when the momentum of short-term returns attracts so much capital that the overall demographic makeup of the market fundamentally shifts.
It shifts from being dominated by long-term investors looking at fundamentals to being dominated by short-term traders looking at momentum.
This completely flips how I've always thought about market crashes. Bubbles aren't really about valuations rising into the stratosphere. The rising valuations are just a symptom.
That's a crucial insight.
Right. The actual disease, the underlying mechanism, is time horizons shrinking.
The game itself changes. The rules of the market literally shift because the majority of the active players dictating the marginal price are now playing the short game.
Wow.
The process feeds on itself. Short-term traders push up the daily returns. Those high daily returns make the evening news. The evening news attracts even more short-term traders who want in on the action. Before long, the dominant price setters are the people with the shortest possible time horizons.
The data the analysis brings in to back this up is just staggering. It points out that while we often romanticize the dot-com bubble as a time of irrational optimism about the future of the internet, the actual trading mechanics of the era tell a totally different story.
Oh, yeah.
The headlines back then were constantly reporting on record trading volume. And high trading volume means people are buying and selling constantly. You don't get record daily volume from people buying a stock and locking it in a drawer for 20 years.
Not at all. And to quantify just how short the time horizons got, The analysis cites a remarkable statistic about institutional money.
Lay it on
In
us.
1999, the average equity mutual fund had a 120% annual turnover rate.
Okay, let's break that down because I think a lot of people just dump money into their 401k and don't realize what that implies.
Right.
A mutual fund is a basket of stocks managed by a professional, right? It's supposed to be the boring, stable vehicle you use to save for retirement.
Right.
So what does a 120% turnover rate mechanically mean?
Mathematically, a 120% turnover means that if a mutual fund manager held 100 different stocks in their portfolio on January 1st,
Yeah.
by December 31st, they had sold all 100 of those original stocks, replaced them with entirely new ones, and then replaced 20 of those new ones again.
That is frantic.
It implies an average holding period of roughly 8 to 10 months.
8 months.
Yeah. So the supposed long-term professional managers entrusted with America's retirement savings were, in reality, only looking about 8 months into the future.
Wow.
And the individual retail investors buying into those funds were doing the exact same thing.
And the analysis references Maggie Mahar's historical account of the era, the book, Bull, noting that by the mid-90s, the financial press had replaced annual performance scorecards with reports that appeared every 3 months.
The quarterly sprint.
Suddenly, if a fund manager underperformed for a single quarter, investors would just yank their money out and move it to whoever had the hottest hand over the last 90 days.
Exactly. This structural change in how performance was reported spurred investors to relentlessly chase momentum. They rushed to buy the funds at the very top of the 90-day charts, usually right when the underlying assets were the most expensive.
Which is the worst time to buy.
Exactly. It was an era defined by day trading, short-term option contracts, and up-to-the-minute market commentary. As the analysis concludes on this point, those mechanics are the antithesis of long-term value investing.
Okay, so we can see how the plumbing of the stock market gets hijacked by shrinking time horizons. But the truly brilliant part of this analysis is that it proves this isn't just a quirk of digital stocks.
Right.
It synthesizes this history with something completely physical, tangible, and traditionally slow-moving, which is the mid-2000s housing bubble. It shows that the exact same mechanical disease applies to bricks and mortar.
Real estate is the perfect proving ground for this theory because a house feels so permanent.
It literally has a concrete foundation.
It does. But the analysis asks us to look at the mechanics of a simple two-bedroom Florida tract home during the peak of the mid-2000s bubble.
Okay. If your goal is to buy that Florida house to raise your family in for the next 10 years, paying $700,000 for it is objectively absurd.
It is.
The analysis mentions price-to-rent ratios. Let's explain why that matters to a 10-year buyer.
A price-to-rent ratio is a very basic fundamental metric. You look at how much it costs to buy a home, and you divide it by how much it would cost to rent a similar home for a year. Makes sense. Historically, if that ratio gets too high, say it costs 25 or 30 times more to buy than to rent, it is a terrible financial decision to buy. On a 10-year horizon, the carrying costs, the interest payments, and the lack of relative equity growth will just destroy your wealth compared to just renting.
So the long-term buyer looks at the $700,000 price tag, runs the ratio, and just walks away.
Exactly.
But once again, apply the shifting time horizon. What if my plan isn't to live there for 10 years? What if I am a flipper and my plan is to own this house for exactly 3 months?
Then the 30-year price-to-rent ratio is completely irrelevant to you.
Completely irrelevant.
You aren't renting it out. You aren't paying a 30-year mortgage. You probably have an adjustable rate or interest-only loan that requires very little cash up front. Your entire financial model is based on one single assumption.
And what's that?
The price of this house will be 5% higher in 90 days.
And the data shows just how many people started playing this 90-day game. The analysis brings in transaction tracking from a company called Atom.
Oh yeah, the Atom data.
They looked at homes that sold more than once in a 12-month period, which is the literal definition of a flip. And the surge is terrifying.
It went from about 20,000 flips in the first quarter of 2000 to over 100,000 flips in the first quarter of 2004.
A 5-fold increase.
A 5-fold increase in short-term players entering a traditionally long-term market. And predictably, after the bubble burst and the momentum died, the volume of flipping plunged right back down to historical norms.
Do we honestly think those 100,000 flippers were sitting at their kitchen tables analyzing long-term income growth in the Florida job market, do we think they were modeling out property tax increases over a decade?
Of course not, because those fundamental data points belong to a game they were not playing.
Exactly.
The only metric that mattered to the flipper was short-term momentum. And for several years, that momentum was undeniably real.
You can call these flippers irresponsible. You can shake your head at the massive leverage they were taking on, but you cannot say their actions lacked an internal logic.
No, you can't.
Within the highly specific, hyper short-term momentum game they were playing, buying a $700,000 house to sell for $750,000 a month later made sense.
They were playing the momentum game effectively
Yeah,
until the music stopped.
right. I want to use an analogy here to clarify this dynamic between the different players for the listener.
Let's hear it.
Imagine a speeding passenger train. If your specific game is to treat this train like an extreme sport, you jump on as it speeds past, you feel the rush of the wind, and you jump off safely at the very next station.
Okay.
It is a highly dangerous game, but you can win it. The train's speed is actually an advantage to you.
Sure.
But imagine you are a different kind of passenger. Imagine your goal is to lay down roots, build a foundation, and start a family on the floorboards of that same speeding train.
Wow.
When the train inevitably derails because it was going too fast, the extreme sport jumper might have already hopped off, but the family building a life is going to get absolutely destroyed.
That captures the structural danger perfectly. The flipper is jumping off at the next station. The long-term homebuyer is trying to lay down roots.
But this brings us to the most terrifying part of the entire deep dive, and it's the transition into the climax of the financial argument.
Yes, the blind collision.
Exactly. If the short-term traders are playing their own logical, albeit risky, momentum game, how do the innocent long-term investors, the ones trying to lay down roots, end up losing all their money?
Right.
Like, how did $8 trillion vanish from regular households who weren't flipping houses or day trading Yahoo?
That widespread destruction occurs during a phenomenon we call the blind collision.
The blind collision. This is where the actual lasting damage happens to society. The underlying logic here is chillingly clear. Bubbles do their catastrophic damage when long-term investors who are playing one game start taking their pricing cues from short-term traders who are playing a completely different game.
Let's examine the specific historical collision the analysis provides. It takes us back to 1999 again, looking at Cisco stock.
Cisco, right.
Over the course of that year, Cisco's stock rose 300% to $60 per share.
And at $60 a share, Cisco's total market capitalization, the implied value of the entire company, reached $600 billion.
That's massive.
The analysis rightfully calls that valuation insane.
To understand why it was insane mechanically, the analysis references economist Burton Malkiel. He ran the math on what a $600 billion valuation actually demanded of the company.
And what did he find?
Malkiel calculated that for Cisco's stock price to be justified by fundamental cash flows, its implied growth rate would have to be so astronomical that Cisco would literally become larger than the entire United States economy within 20 years.
Which means every single dollar spent by every consumer and business in America would have to be spent on a Cisco internet router.
Exactly.
It is a mathematical impossibility. So we know that very few people buying at $60 actually believed the long-term fundamentals supported the price. The day traders were just riding the momentum, playing hot potato.
But here is the structural trap. This is how the long-term, responsible investor gets pulled into the wreckage.
Walk us through it.
If you were a long-term investor in 1999, say you are a 45-year-old trying to build a responsible retirement portfolio, and you decide you want exposure to the infrastructure of the internet,
Makes sense.
$60 was the only available price for Cisco.
Right. You can't call up the New York Stock Exchange and say, hi, I'm a 30-year buy and hold guy. I know the day traders have pushed this to 60, but based on my discounted cash flow model, it's only worth 15. Can I get the fundamental price, please?
Right, the market doesn't care. You have to pay the $60 that the short-term momentum players have established as the marginal price.
Exactly. And because the market forces you to pay that price, human psychology inevitably takes over.
Always does.
You look at the ticker, you see the massive trading volume, you see the constant upward momentum, and you begin to doubt your own math.
You really do.
You say to yourself, wow, maybe these millions of other investors know something I don't. Maybe the paradigm really has shifted. So you abandon your fundamentals and you buy it at $60.
And what you completely fail to realize in that moment of surrender is that The people setting that marginal price, the anonymous traders dictating that it costs $60, are playing a fundamentally different game than you are.
A completely different game.
The analysis hammers this home. $60 a share was a perfectly reasonable price for the momentum traders because they were going to sell it before the closing bell anyway.
They didn't care about 20 years from now.
The implied 20-year growth rate didn't matter to them at all. But $60 was a slow-motion disaster for you because you planned on holding those shares for 20 years, and the long-run math was physically impossible.
The visual the analysis creates here is just profound. These two investors, the momentum day trader and the passive retiree, they rarely even know that each other exists. They have completely different risk profiles, different time horizons, and different goals. But they are operating on the exact same field, running blindly toward each other.
And when their paths cross and the long-term investor adopts the short-term price, the long-term investor gets severely hurt.
And this collision between the 30-year buyer and the 3-minute trader is magnified 1,000 times over by how we actually get our financial news. I call it the CNBC trap, and the analysis highlights it perfectly.
The role of financial media is critical here because so much of our financial decision-making is rooted in social proof.
Yeah.
We watch what other people do, and we either try to copy their success or bet against them. But if you don't understand why someone behaves the way they do, if you don't know what game they're playing, you have no idea how long they will keep acting that way, or what specific data point will make them suddenly change their mind and sell.
The analysis gives a brutally honest breakdown of financial television. It points out that when a highly paid commentator on a financial network looks into the camera lens and declares, "You should buy this stock right now," you have to remember one crucial fact.
What's fascinating here,
That commentator has absolutely no idea who you are.
none whatsoever. They are broadcasting a single instruction into the void.
Are you a 19-year-old trading on an app with money you don't mind losing? Are you an 80-year-old widow living on a strictly limited fixed income? Are you a multi-millionaire hedge fund manager trying to shore up your books with a quick momentum trade before the quarter ends?
The absurdity of the broadcast model is laid bare when you think about it mechanically. Are we genuinely supposed to believe that those three drastically different people with three drastically different risk capacities have the exact same financial priorities?
It makes no sense.
Are we supposed to believe that whatever price a stock happens to be trading at right this exact second is the optimal right move for all three of them simultaneously? The underlying logic screams that it is impossible.
So, for the person listening to this deep dive right now, maybe you are sitting in traffic or you're walking the dog and you've just opened your 401k app or your brokerage account, the immediate danger is assuming that the universal buyer-sell signal being broadcast by the media applies to your specific life.
What's fascinating here is the psychological anchor at play. We suffer from a deeply ingrained cognitive bias where we fail to realize that rational, intelligent people can see the exact same set of facts through a completely different lens than our own. We assume our goals are the default goals.
Right. And when you add the visceral thrill of making money to that cognitive bias, it becomes intoxicating. The analysis literally describes rising prices as a drug.
They are a highly potent behavioral drug.
Yeah.
The momentum of rising prices persuades investors in ways that the most brilliant marketers in the world could only dream of.
For sure.
That drug can take deeply value-conscious spreadsheets and fundamentals investors and turn them into dewy-eyed optimists in a matter of weeks.
It's crazy to watch.
They become completely detached from their own mathematical reality, simply because they are mesmerized by the flashing green numbers generated by someone playing a totally different game.
It is terrifying when you realize how subtle the trap is. You think you are making a rational choice based on the data in front of you, but the data you are looking at, the price, was manufactured by an anonymous crowd whose goals are entirely foreign to yours.
And if we step back and transition from the high-stakes world of Wall Street down to Main Street, we see that this phenomenon isn't just restricted to multi-trillion-dollar stock markets or massive real estate bubbles.
No, not at all.
The exact same mechanical flaw in how we process social cues bleeds into our daily lives and our everyday consumer behavior.
This is where the analysis takes these lofty macroeconomic concepts and puts them right into the wallet in your pocket. Because taking behavioral cues from people playing a different game throws off how we spend our own paychecks every single day.
The underlying dynamic of consumer spending, particularly in wealthy developed countries, is that it is deeply socially driven.
We like to think we buy things purely for their utility, that we buy a car just to get from point A to point B, but that is rarely the whole truth.
Very rarely. We buy things because we are subtly, often unconsciously, influenced by the people we admire in our social circles, and we make purchases because we subtly want those people to admire us back.
But the analysis points out a massive visibility problem in this social dynamic. We can clearly see the external physical markers of wealth.
Right.
We see the brand new luxury SUVs our neighbors drive. We see the square footage of their homes. We see the designer labels on their clothes, and we see the curated photo albums of their expensive vacations on social media.
Exactly. The outputs are highly visible. But what we cannot see are their internal realities.
Yeah.
We cannot see the underlying math of their lives.
Yeah.
We cannot see their long-term financial goals, their hidden credit card debts, their daily anxieties about cash flow, or the specific professional aspirations they are trying to fund.
To ground this, the analysis provides a highly specific, incredibly relatable example of this disconnect in action.
The lawyer and the writer.
Yes, think about two entirely different career paths. On one hand, you have a young, ambitious lawyer who is aggressively aiming to make partner at a prestigious white-shoe law firm.
For that specific lawyer, operating in that specific environment, maintaining a highly polished, expensive appearance, might be a genuine mathematically sound investment in their career game.
Because the senior partners expect them to look the part.
Exactly. The high net worth clients demand to see external markers of success before they trust them with their legal affairs. For the lawyer, buying a $3,000 designer suit or a luxury watch is essentially a capital expenditure.
It has a measurable return on investment.
It does.
But then look at the other side of the comparison. Think about a freelance writer, someone who works from a home office, communicates entirely via email, and can comfortably do their job in sweatpants.
I love the image of the writer in sweatpants. It really hits home.
The writer has absolutely zero professional need for a $3,000 designer suit. Their clients, the readers, do not know or care what they are wearing when they sit at their keyboard. For the writer, that suit has a return on investment of zero. It is a pure sunk cost.
The danger arises when the writer starts looking at the lawyer for social cues. If they live in the same neighborhood and the writer sees the lawyer buying the expensive suits and a luxury car, the writer might internalize those purchases as the baseline expectation for what success looks like.
Right.
If the writer lets the lawyer's game dictate his own spending, he is wandering down a path of severe financial friction and deep potential disappointment.
Because he is spending the exact same amount of money on the suit, but he is completely failing to get the career boost that the lawyer is getting. He is just out $3,000, so he can sit in his home office looking fancy for nobody.
The core argument here is brilliant in its simplicity. We might not even have different aesthetic styles. We might both legitimately like the look of the suit. But we are playing fundamentally different games with our money.
That framing really hits home because it makes you stop and audit your own life. Think about your own daily spending right now. Whose game are you accidentally playing? Are you buying the lawyer's suit? Maybe in your life it's an oversized truck you don't use for work, or a neighborhood with property taxes you can't really afford, when you are genuinely a sweatpants writer at heart.
Are you bankrupting yourself trying to keep score in a match you aren't even officially entered in?
That kind of social mimicry creates a silent, constant financial drain on millions of individuals. We deplete our savings trying to keep up with players who are optimizing for entirely different variables in life.
It's a deeply entrenched habit for most of us because humans are biologically wired to fit in with the tribe.
Right. So if the ultimate mechanical danger is accidentally playing someone else's game, whether that means day trading tech stocks based on momentum, flipping Florida houses, or buying suits you don't need, the ultimate defense has to be rigorously, almost ruthlessly defining your own game.
Exactly. This brings us to the actionable, empowering conclusion of the deep dive. How do we mechanically protect our portfolios and our peace of mind from all this chaotic noise?
The ultimate takeaway from the analysis is stated with absolute clarity. Few things matter more with your money than explicitly understanding your own time horizon and vehemently refusing to be persuaded by the actions and behaviors of people who are playing different games than you are.
But to accomplish that, you first have to overcome a massive linguistic trap that the financial industry has set for us.
The word investor. It is such a dangerous blanket term. It's like calling everyone who touches a spherical ball a basketball player. You wouldn't look at LeBron James playing the NBA Finals and a 10-year-old playing horse in their driveway and say, well, they are both basketball players, so they should be using the exact same strategy, right?
Right. They're stepping onto completely different courts, playing by different rules, trying to score entirely different kinds of points. But we do exactly that with the word investor.
We really do.
We group the day trader, the hedge fund manager, and the 30-year passive index fund buyer under one single label, as if they were all trying to achieve the same goal.
But we just spent the last 45 minutes proving how mathematically and mechanically wrong that unified notion is. A momentum trader and a retirement saver are not playing the same game. They aren't even participating in the same financial sport.
When you truly internalize how wrong that unified label is, you realize how vital it is to explicitly identify your specific game. It is shocking how few of us actually take the time to do this mechanically. We just drift.
We open the brokerage accounts, we watch the news, and we buy whatever the prevailing momentum tells us to buy.
But the analysis offers a highly specific personal solution. To break the cycle, you have to write out a concrete, single-sentence mission statement for your own finances.
The author of the text shares their own, and I think analyzing it word by word is incredibly powerful.
Let's do it. The mission statement provided is, I am a passive investor, optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments.
Let's look at the mechanics of that sentence. I am a passive investor. That immediately eliminates day trading.
Right.
Optimistic in the world's ability to generate real economic growth. That establishes the fundamental basis for the investment, global macroeconomic expansion, not quarter-to-quarter earnings beats.
Exactly.
And I am confident that over the next 30 years, that growth will accrue to my investments.
That establishes the strict 30-year time horizon. Now, at first glance, that might seem quaint or almost too simple to be considered a sophisticated financial strategy. But the mechanical superpower of that written mission statement lies in what it actively allows your brain to ignore.
Yes. It acts as an incredibly efficient, ruthless information filter.
By clearly defining the game, you aren't just deciding what to buy, you are deciding what information to completely ignore.
Because this investor's game is exclusively tied to 30 years of passive global economic growth, they suddenly do not have to care what the stock market did this specific calendar year. A 20% drop in a single year is mathematically irrelevant to a 30-year horizon.
They do not have to care if the talking heads on television are screaming that there will be a cyclical recession next year.
Because next year's recession belongs to a completely different game. It is a data point that is entirely relevant to the one-year hedge fund manager, but entirely irrelevant to the 30-year passive investor.
By defining the game, this investor is in absolutely no danger of being persuaded by the fear or the panic surrounding that specific event.
This is the ultimate mechanical antidote to the CNBC commentator problem. By clearly defining your specific rules, you aren't just making a list of what assets to buy. You are aggressively, intentionally deciding what categories of information to completely ignore. You reclaim your cognitive bandwidth and your emotional peace of mind.
You build a firewall against the blind collision. You see the momentum traders pushing a stock up 300%. And instead of feeling FOMO, instead of abandoning your models and copying their homework, you can objectively observe them and say, they are playing a game of short-term momentum. I am playing a game of 30-year global growth. Their actions have no bearing on my strategy.
I want to challenge everyone listening to this right now. You need to physically execute this step. Get a piece of paper or open the Notes app on your phone and write your own financial mission statement. Define your time horizon. Define your metrics for success.
It's the most important homework you can do.
Because the mechanical reality of the market is ruthless. If you do not know exactly what game you are playing, someone else is going to draft you onto their team. And I guarantee you they are not going to care if you lose all your money, as long as your capital provides the temporary momentum they need for their own short-term trade.
That is the harsh underlying truth of financial ecosystems. Okay. The market is constantly, aggressively trying to recruit your capital into games that serve other people's interests. Your only structural defense is knowing your own rules intimately.
Okay, let's take a breath and look back at the massive ground we've covered today, because this really is a total paradigm shift in how we view financial behavior.
It's a lot to take in.
We started by staring down the barrel of trillions of dollars vanishing in the dot-com and housing crashes. And we dismantled the lazy, comforting idea that it was all just caused by a sudden outgrowth of human greed.
We discovered that the real culprit is a mechanical failure in how we process pricing information. We falsely believe in the fallacy of the single rational price, failing to see that an asset can legitimately have drastically different values based entirely on the specific time horizon of the buyer.
We looked at the mechanics of the late 90s, where 120% mutual fund turnover rates proved that the time horizons had collapsed. We saw how the Florida house flippers in 2004 played a highly specific, short-term momentum game that totally ignored fundamental realities like long-term price-to-rent ratios.
We saw how their short-term games essentially hijacked the pricing mechanism of the entire market.
And we explored the tragic mechanics of the blind collision, where sensible long-term investors saw those artificially rising prices, assumed the short-term traders knew some secret fundamental truth, and copied their homework, buying assets at marginal prices that guaranteed devastating long-term losses.
And we even brought it all the way home to the lawyer in the expensive suit and the writer in the sweatpants, proving that taking social cues from people optimizing for different life goals can bankrupt our everyday checking accounts just as easily as our retirement portfolios.
And we arrived at the ultimate mechanical protection against all of this noise, self-knowledge. Writing down your own mission statement so you can build an information filter against the games you aren't playing.
But as always, knowledge is only truly valuable when it is applied to reality. So the task for today is to actually write that sentence down.
But before we sign off, I want to leave you with one final, lingering question to chew on. Something that builds on everything we've analyzed today and applies it to the immediate future.
Okay.
We talked extensively about the media, about the CNBC trap of broadcasting generic advice to millions of drastically different people. But think about the structural environment of today's world. Think about the mechanics of social media. We live in an era of gamified trading apps that shoot digital confetti across your screen when you execute a trade.
Yeah, the gamification is intense.
We have financial influencers on platforms like TikTok delivering rapid-fire, highly leveraged trading advice in 30-second clips. The entire financial ecosystem is increasingly designed to mimic the mechanics of pure entertainment.
The structural lines between investing, speculating, and social gaming are more blurred today than they have ever been in financial history.
Exactly. So here is the question you need to ask yourself. How much harder is it to tell who is playing what game today when the players setting the marginal prices are hiding behind anonymous usernames, diamond hand memes, and rocket ship emojis?
Oh, wow.
Are the structural boundaries between the games blending together so much that it's becoming practically impossible to separate the day trader's noise from the 30-year investor's signal? And if the noise is that much louder today, how much more fiercely do you have to guard your own written mission statement just to survive the next decade?
It is a vital existential question for anyone deploying capital in the modern digital landscape.
Think deeply about that the next time you feel that visceral, chemical urge to abandon your spreadsheet and follow the momentum of the crowd. Oh, and briefly, looking ahead, the analysis leaves a little breadcrumb at the very end of the text. It simply notes, next, let's talk about pessimism.
Oh, interesting.
So it sounds like we might just have to take a deep dive into the underlying mechanics and psychology of pessimism next time around. But until then, define your game, ruthlessly filter the noise, and thank you so much for joining us on this deep dive.